It gives me great pleasure now to bring on board Nilesh Shah of Kotak AMC to talk about markets, view on the world, and what his view on gold and silver is. Nilesh bhai, fantastic to have you back. Thank you for joining us. Hope everything's fine at your end, your wife and your daughters, and everyone is safe.
Right. We have taken all the precautions and so far so good.
Well, so good to hear that. Now, somewhere is Nilesh Shah, the investor, excited that this market strength has surprised everybody, or disappointed that this market has run up too ahead of themselves and a fall from the top of the cliff is round the corner?
I really don't know how to predict market move, but clearly this is one market which has taken everyone by surprise by staging a sharp recovery. We think from being overweight equity position at about 7,000 to 9,000 Nifty, now it is time to be neutral weight equity. Valuations have got stretched, and this is time to be neither underweight nor overweight equity. It is time to maintain that position which you can afford to keep for long term, and where some amount of volatility you can bear.
So, Nilesh, the question is, if markets are going higher, if economy has not recovered, what is the best way to invest in this kind of an environment? Like you always say that markets are forward looking, but markets historically, at least in last 2 or 3 years, they've gone wrong in predicting the earnings cycles. So is that the biggest risk right now? Whether it is liquidity or lack of alternatives, markets have gone higher, earnings are not there, and it's not that markets have been accurate in predicting the earnings cycle. They've time and again, they've gone wrong there.
The best way to invest, like yesterday and today and probably as well tomorrow, is to invest in good businesses run by good managers available at good prices. Very easy to say, but very difficult to execute. What I will recommend investors is that buy quality companies where you believe managers will work for you and not cheat you, and try to build a margin of safety in prices. Today, if you value companies on FY21 earnings, in most cases you will find them trading at lifetime high valuation. But that's because FY21 profit have disappeared. You are buying companies not for FY21 profit, but far beyond that. So try to buy those companies where you believe growth will be higher, they will survive the current downturn, and their margins over a period of time will normalize. At Kotak Mutual Fund, I have requested my team members to ensure that our portfolios pass through following filter. One, our portfolio companies should have less leverage, because we believe leverage will become lethal in the days to come and impact shareholder value far more. Second, our portfolio companies should have as lower break-even as possible in terms of operating cost. They should not have very high fixed overheads. They should have cost structure which will allow them to survive in the downturn. And third, we are looking to invest in companies which are top 3 or 4 in their respective sectors. There's no point in investing in Me Too companies or who are followers. And obviously, all this are applied to the common filter of companies and governance, which we believe will work for minority shareholders. Very simple things, but very difficult to do when you see penny stocks running in the short term.
Sure, absolutely. So, Nilesh, what we've seen in the market is that the mid and the small caps have just about begun their recovery and perhaps fast catching up to the large cap universe. Are you saying you're not convinced about the rally across the broader universe which is playing out?
So again, it all depends upon now stock specific. The days of sector specific rally is probably behind us, and one could see a scenario where a portfolio of quality stocks across large, mid, and small can still outperform the market. The focus has to be in buying companies which are less leveraged, companies which have lower operating costs, and companies which have leadership positions or ability to innovate to survive the downturn. COVID-19 related crisis is a long haul. It's not going to go away in 1 or 2 quarters. Companies will take time to come back to their normalcy, and they'll have to cut costs aggressively in order to survive the downturn. So we won't be able to judge across entire sector. We'll have to pick up our own stocks on a bottom-up basis as to how they are cutting cost, how they are innovating to survive the downturn.
Sure. In the near term, though, Nilesh, what is the sense that you're getting about IT and pharma? Because, that's where people have made maximum returns. Do you think easy money has already been made and the best of the returns are behind us when it comes to IT and pharma? Again, only in the near term.
So it's always very, very difficult to predict near term because flows can remain stronger than the fundamentals. There is a famous saying in the market which says that markets can remain irrational more than you can remain solvent. But my feeling is that at least in the near term, the momentum on IT and pharma is likely to continue. People are worried about other parts of economy, especially on investments, infrastructure, engineering, capital goods. They will look towards the safety of IT, pharma, and FMCG kind of sector. Most IT and pharma companies have lesser leverage. They also have fairly robust cash on the balance sheets, which will help them survive the downturn. And more importantly, both the sectors today are poised for some growth pickup in the days to come, courtesy COVID-19 environment. So the momentum is in their favor, but my recommendation is please buy quality stocks, keep a watch on valuation, let the momentum not mislead you.
Okay. Nilesh, in terms of, newer themes, even if they're longer term themes, what are you making of the government's push on manufacturing, the kind of sectors that will stand to benefit from that? Are you looking at it as a theme that will play out? Are you positive on it?
There is lots of opportunity in this supply chain disruption happening out of China. India is competing well with other nations to grab as much share as possible from this supply chain dislocation. Clearly, many of our competitors are way ahead of us in terms of infrastructures, in terms of ease of doing business. But collectively, all our competitors put together does not have large domestic market like India has. Government has taken many initiatives for popularizing Make in India. And we believe there are two particular sectors, chemicals and contract manufacturing, where there could be stupendous opportunity, just like IT sector in 2000. In both these sectors, we are seeing expansion in global market share. We are seeing emergence of large buyers, just like in IT sector we saw. And we are seeing that companies will be able to scale their business multiple times current turnover if they follow the right path. This kind of opportunity arises rarely for a sector, and the way IT sector converted Y2K opportunity into building billion-dollar businesses, we see companies in chemicals and contract manufacturing converting this COVID-19 related opportunity into a long-term value creation. Obviously, market has recognized this, and in both this sector, companies are trading at extremely high valuation. But the long-term growth opportunity in these two sectors is humongous. As government policy unveils on electronic sector, electrical sectors and defense sectors and so on and so forth, we will see opportunity arising in those sectors as well, depending upon how things gets executed on ground. One thing is to make an announcement. The second thing is to actually make it work on ground. So we'll have to build our portfolios cleverly and with looking at valuation as well as execution on ground in those sectors where government is providing incentives.
Okay, fair enough. Nilesh, one of the sectors that can also see an impact of this is auto, which already has, of course, capacity, when it comes to manufacturing. When you're looking at some of the auto names currently, how are you assessing them and how are you really discerning within the pack? Are you looking at the consumption angle? Are you looking at the Make in India angle? Are you looking at, whether it's rural versus urban and where the pickup's going to come from? Because it's an industry that we're continuing to see disruptions in one after the other.
So I'm only looking at profitability and valuation. All the things which you mentioned is part of that single lens to look at things. And based on that, we believe two-wheelers courtesy support from rural India should be in a better position to normalize. Then comes companies which are at the entry level or at the lower end of the car market. Tractors are obviously doing well and they are probably better than even two-wheelers. So it's tractors, two-wheelers, entry-level motor cars. And commercial vehicle is something which is going to take a lot of time to normalize. Now, this is broadly the theme on the industry side where July data has been better than June and June was better than May. But all those data are still at a significant discount to previous year number for industry as a whole. Obviously, there are few companies which have done exceptionally well in that environment. And we are tying that up with the profitability or margin of the companies, as some companies are gaining market share at the cost of profitability, whereas others are maintaining profitability at the cost of market share. So we are trying to evaluate two things. One, where industry is normalizing, and second, where margins are normalizing and trying to build position in auto sector.
Nilesh, I'll ask you a question which in a sense is puzzling all of us. When markets are going higher, normally mutual funds, they get inflows. But June and July have been the other way around for the mutual fund industry. What is the really right way of looking at it? Is this just periodic profit booking, or this is something which is largely a function of the fact that Indians are now migrating towards trading directly and investing directly, looking at the number of demat accounts which have opened?
Nikunj, by now, mutual fund industry has more than 8 crore folios. So there is no homogeneous crowd. There are multiple reasons why we are seeing outflows in the equity fund for the first time in last 4 years. One could be that people are actually redeeming money because they believe market has risen and mutual funds from bottom would have delivered anywhere between 35 to 40% return. Second could be people are actually redeeming money for putting into their businesses, spending money for their livelihood, and so on and so forth. Third could be the reason which you mentioned, that some investors are seeing that, I can trade directly in the market and make better return than mutual funds. So they also may have put some redemptions. Fourth, and probably one of the bigger reasons, is that while a lot of businesses have shifted digitally, there is a large part of India where physical contact is necessary for investment decisions. In the month of March and April, May, mobility was restricted. June, July, mobility improved, but it has not improved to the extent it was before pre-COVID. So hundreds of thousands of mutual fund distributors are not able to reach to their customer and get their application for investment. So put all these things together, there are multiple reasons which has resulted into mutual fund flows turning negative for the first time in equity funds after a gap of 4 years. The good point in all this thing is that SIPs are still holding on. SIP flows has not reduced as much as overall flows have reduced. The faith of hundreds of investors in SIP is remaining robust.
Okay. Nilesh bhai, just when I was preparing for our interaction today, I managed to lay my hand on one of your old presentations, not a very old presentation, but a 1.5-year-old presentation, which talks about examples of how iShare created wealth and how Asian Paints created wealth in last decade. If you really have to bet on one or two outsized themes, the themes which will make money for 3, 4, 5, 7 years, which would be those outside themes? And if you have to make a presentation which is not backward looking but future looking, that how simple ideas can make money, what would you like to include in it?
So one, Nikunj bhai, is bottom up rather than top down ideas by quality companies run by good managers and where growth is available in plenty. So if you can lay your hands on the next Azim Premji's, Shiv Nadars and Narayan Murthy's in chemical and specialty chemical space or in contract manufacturing space, I'm sure that experience will be as rewarding as investing in these companies during IT sector. Now, if you remember, IT sector boom 97 to 2000 was a rocket, 2000 to 2001 was a sharp fall, and 2001 onwards it was a recovery. It was not a straight line journey in IT sector. There were ups and downs because of market requirements or market factors. The same trends will occur in chemicals and contract manufacturing sector also. But if you can identify right companies and right entrepreneurs and stay with the volatility of the market, I'm sure this experience will be as rewarding.